I am Kashish, co-founder at Exfynia. So in today's podcast, we will discuss about the future of the finance, the valuation, AI, and the finance transformations. Today we have Neeraj Agarwal, who is founder of FinTrack Advisors, which is a multi-service financial advisory firm. So Neeraj, if you can walk through us with your professional journey and the key milestones.
Hi, Kashish. First of all, thanks for having me here. It's an absolute honor for me to join this podcast. So, defining my professional journey so far is a bit difficult for two lines, but I'll try to do that. So, basically, we founded FinTrack Advisors 2 years back with the aim of providing efficient services to different parties across the globe. We are currently a team of around 50 professionals who are dealing in different domains like valuation, mergers, accounts compliances, and etc. Our core area is obviously valuations and cross-border mergers. If I have to say something about myself, I'm a chartered accountant by qualification, past 13 years. I've been practicing out of Bangalore for a few years now. I also am a registered valuer in India and a certified valuator analyst CVA in US. So this gives me a global license to practice valuation across the globe. And in FinTrack, we try to provide all these qualities together. We add up these different qualities of professionals in trying to bring it to the best case scenario for all different clients, and that is our main target. So, yeah, I think I have summarized what I do, and hopefully this should be sufficient.
Yes, Neeraj. So that is quite sufficient. And what I understand is your primary service includes a valuation, right?
Correct.
So, yeah. So, so what do you think? How finance is evolving beyond accounting?
So, Kashish, basically, in the last 10-20 years, we have seen a distinct change in the way the accounting is being done over the globe. So, earlier, when we used to feel about accounting, or whenever we used to describe the term accounting itself, it was more like a scorekeeper job of keeping the accounts intact. Maybe somebody doing a monthly reco or something like an annual exercise. But now accounting has developed into a very niche area because now the accountants are expected to know having intrinsic details about the verticals in which they are working, the industry which the company is working. It's not an annual thing or a monthly thing. It's a day-to-day job because accounting is a base on which everything is dependent. Whether we are doing valuations, we're doing due diligence, anything, and overall the regime has become very strict. So any sort of small lacunas or gaps in your accounting system can make you pay a hefty amount. So there has been a big evolution in terms of what we are doing in accounting, and now accounting is a vertical which joins all other verticals together. So whether we are talking about due diligence, compliance, everything comes from accounting. So for me, accountants or people who are working with the accounts departments are like, to take an analogy from football because FIFA World Cup is going on. Accountants are like those unglamorous defenders in the team who do the dirty work for the team, and ultimately the glory goes to the sales department, the strikers. So for me, accountants are those defenders, but without those defenders, you cannot win the match. Like they say that goals wins you match, but solid defense wins you the entire tournament. And this is purely true for accountants in these days. The evolution with the augmentations of AI and all has been profound, especially in the accounting job. Because one way we can say that, okay, yeah, with the AI, the mechanical or the technical things have gone down, but with AI, uh, you can say more and more visual things are coming up, like things which were not being earlier checked. Now we can scope of that also have increased. So yeah, there are a lot of scrutiny on the way the accounts are being prepared now, and that is why I think the role is important and it will continue to play a major role.
Right, Neeraj. So I just like your example of the FIFA World Cup and the defenders, and yes, I echo with your point regarding the AI. Yes, yes, AI will reduce our manual work. It will create a, but yes, the review part is, the onus is on the accountant only to review that. Yeah. Okay, so moving forward, so what do you think? Why valuation matters for the growing businesses?
I think valuation matters because of the fact that without valuation, you cannot have a third party investor coming on board. It is the first thing which any investor will look into. So nowadays we are so one of the days when profit was the only stake or the only consideration a company had to look into. We see so many startups which are in the early stages or even growth matured startups which require external funding. So the first document, what will the investor ask you for? They will not ask you for your provisional financials because obviously that will come the second part. The first documents or your introductory document is a valuation report. Your company, and when we say valuation report, valuation is a all comprehensive document. It is just not about the numbers. It is about the story of the founders. It is about the story of the industry. It is about story of everything regarding the company. So valuation gives an all-round 360-degree perspective to the investors or the third party. Now, with more and more assessments or more scrutinies coming up, you'll see that valuation have become an exercise which was earlier only for fundraising. Now it has camouflaged and it has become a year-round exercise with more and more compliances also joining. For example, I don't know how many people know that with AICPI guidelines in US, if you have an ESOP policy in the company, you are required to do quarterly or half-yearly ESOP valuation reports. You have 409 evaluations in US. You have ESOP valuations in India. Then if you're having RSU valuation which have to be done as on the grant dates. So valuation is no longer an exercise which was done on an annual basis. It has now become almost I won't say it is matching with accounts, but it is something which is coming up pretty close. It's becoming a year-round exercise. And obviously funding is going to be an essential part of in all these startups. Now we're not talking about listed or matured companies, we're talking about early stage startups, mid-sized startups who require a substantial amount of third party commitments, and that can only be done through valuations. So and this valuation is now becoming like a area which is comprehensively taking in part in other areas also. So last 2 years back, the international valuation standards, they made ESG reporting mandatory in valuations. So now what has happened is that if you're doing valuation of a company, you will also have to highlight that what is the ESG ratings of that company or how well it is doing in ESG. So this is a true example of interplay. So between the two verticals. So valuations. If you again using the FIFA analogy, I always consider accountants as defenders and valuators as maybe the team coach or team scouts because valuators are involved with so many things because we are dealing with third parties also and we are dealing internally also. So yeah, valuation is an all comprehensive area and the role of valuators will keep on growing. And now you will see in a lot of corporates there's a specific team for valuation, which was not the case maybe 10, 20, 30 years back, in which listed companies had only accounts or tax or indirect taxes. But now there are specific teams which are only for valuations of the company, or there are teams who does valuation for the investors. And in India, you will see, or in US, you will see a lot of entities which are purely now working in the field of valuation, which was not the case 15, 20 years back. Now the term valuation itself has become a common analogy everywhere, which was not maybe the case some few years back. So yeah, valuation is now everywhere.
Yes, right. Agree to your point, Neeraj. So, so what is the importance of clean financial data and controls, and does it have any impact on the valuation as well?
You asking me this question, what is the impact of clean accounts means somebody asking me what is the benefit of having a clean or a healthy body. You without a healthy body, a person cannot just function, and that is the case. Like I told you that without accounts we cannot do anything. So without a clean accounts, you cannot do compliance. You cannot do go for valuations. You cannot do you cannot move. It's just like a person who's paralyzed. So and yeah, from a values perspective, I think yeah, if you ask me, which is more interesting to you, whether working with a company which has a very clean accounts or whether working with a company which has a very difficult or messy account. So from a professional point of view, I may say working with a company which is having a messy accounts because it makes me think, it makes me focus on things which we were not really putting our efforts into when the accounts are purely clean. But yeah, obviously, from a company's internal point of view, from statutory compliances point of view, you want the company to have a pure clean accounts. In clean accounts, it is the role of the accountant as well to maintain everything. It is also important to have a software which helps you area specific software, because now we are into an era of specialization. So we cannot consider any sort of generic software for our specific type of industry. It is like having a heart issue and going to a general physician. You cannot do that, right? Similarly, you will have to have a specialized accountant in your company. You will have to have a special software which is dedicated to your industry area. And that way, a clean accounts means a happy valuer, a happy investor, and a non-interrupting government. Because if your accounts are good, you will not have interruption from the government in terms of penalty and compliances. So it's pretty much comparable to a healthy body. Your body is clean, you don't need to go to see the doctor.
What financial and operational metrics matter most for SaaS and AI companies?
That's a very difficult question for a valuator to answer. Why? Because nowadays, when we are valuing a company, and that is some companies are pretty pre-revenue companies which have just started, the expectations are for the fundings are so high, and they don't have anything in place. It becomes very subjective and very difficult for us to ascertain what to value these companies. So there are different things which we have to see. Now, coming to purely your AI or SaaS-based company, we have to consider the fact that even if there are two companies which have the same revenue, but if they one is working in SaaS and one is working in an AI industry, the ultimate profit will not be the same. The cost may be different. So the term, the assumptions and the parameters which we have to use for both of these industries are very different. Secondly, gone are the days when your pitch deck was the sole document through which you could pitch it to the third party investors and get a funding. Now the investors are asking difficult questions. Your valuations or your document needs to have a detailed analysis of what you're doing regarding the cost of acquisition of a customer. Earlier there was a lot of earlier a lot of time the people investors were happy with the fact that you were getting in new customers on board, but now there has been shift in alliance or allegiance. The companies wants you to retain the customer. So what is the cost of retaining the customer? What is the cash burn which you are doing to retain a customer? Because if your product is good, the customer should be retained automatically. It should not be a very hard process for you to keep on retaining your customers. What is the customer acquisition cost? So all these questions are there. Some of these questions are same for both AI and SaaS-based company, and some of these entities, but the answers will be different. Why? Because the industry is different for AI. In AI, we see because there's a lot of R&D cost which is there right now, and the cost is significant even after you already have a genetic tool which is ready. In SaaS, once your software is ready, maybe the cost of maintaining the software will be quite less as compared to what you're doing in a AI genetic AI tool. So all these things are different for AI and SaaS. We will, whenever you are analyzing a valuation report or preparing a valuation report, you must read the industry of the both the entities, what they are doing, and see. As a layman, we always say AI or SaaS, but we are not getting into the fact that SaaS is an umbrella term, AI is an umbrella term. There are multiple verticals inside SaaS or AI. So you even when you say AI, there can be multiple ways that we have to look into this, because AI or SaaS may be a way to produce or work for these companies, but ultimately, what are these companies for? So, for example, if you have an AI company for medical, that cannot be compared to a AI company which is in health tech, right? So, ultimately, for us, whenever we are working with any company, it is important for us to look into what is the primary goal of those companies, which industry are they going to supply, and not primarily that whether they are using AI or SaaS. So because these can be tools, but ultimately, what industry are you going to service? If that makes sense to you.
Absolutely, Neeraj. So, just one question, just out of the curiosity. So, since your primary service is evaluation, so do you step in for the clients as well while they go for the fundraising?
Definitely, definitely, we have to do that. So because see, we have to be of the view that the clients, the founders have a restricted view because they are coming from some background. They may be technical people in their operations part, but they are not people who are very prone or very have a lot of detailed analysis of how the valuation works, right? They may have a number in mind, but then how do you define that number to the investor? So uh, it's like something which we want to avoid, because sometimes it becomes that we are the pitcher, and it looks like that we are asking a fund for our own company. So it is something which we want to avoid, but I think six out of 10 times we have to get involved with the pitching part also. And yeah, because ultimately you have to see what is the end goal of this valuation exercise. If it's an exercise for fundraising, if the client doesn't get the funding after your due diligence and valuation, then the entire operations become moot. So you will have to help the client in whatever way possible, and it's a two-way thing. Obviously, you help the client, the client helps you. So yeah, we have to get involved with this.
Okay. So that was something, a new learning for me. And obviously, yes, you are right that, you have prepared the valuation, so you know the insights better than the, a founder of the company. He might be of any background. Yep. Right, Neeraj. So the next question for you is, for fast growing SaaS and e-commerce companies, how do scalable finance systems and accurate reporting influence valuation and investor confidence?
Even before we say about investor confidence, a good report or a good accounting system actually gives us a lot of confidence. Because if your operations or accountings are not correct, then it doesn't really help us with our valuation. Because see, valuation is an exercise which wants to get the fair value of the company and not the value which is presented in your accounts, right? So you may be paying your director X amount of salary, but that may be not be the market case. It may be higher in the market. The same director could get a higher number or a lower number. So clean accounts or a fair accounts really help us to get those numbers in order, because we cannot just rely on the audited accounts. So a lot of times, in case of valuation, we ask the management to get us a clean accounts, which means that make operational changes and get to the number which is actual number and not the number which you have presented right now to your auditor and all. Because there's a difference between the audited numbers and what numbers we are presenting for valuations. So your accounting, your account department, and your software should be dynamic with the whatever is requirement for the valuation. And obviously, a clean accounts, like I told you, the other questions also, a clean account helps you with your compliances part also. Because obviously, a lot of times we take compliances for as a guaranteed, but your investor, your third party investor or government, they will go for the compliances also. Maybe not at the first stage, but maybe the second stage. So if you don't have an accounts, clean account system, whether you are in e-commerce, whether you are SaaS, whether you are AI, you will not be able to present any sort of report to anybody, right? And especially in the case of e-commerce, we see a lot of e-commerce companies struggling with the way the accounts are being handled, because you are also a better judge for this. That you see in e-commerce, you have multiple verticals which are functioning together. So there's a payment wallet which will be ultimately getting your money, and then they will releasing the money, and they will have a different report. Your website may have a completely different report, and ultimately whatever report you are preparing and filing with the governments, respective governments, that can be different. So sometimes it happens that we have 4 or 5 numbers which are all different stories. So ultimately, if you have a very unless you have a very dynamic account system, accountant, and you prepare a very clean report, you cannot go for anything. You cannot go for compliance. You cannot go for funding. You cannot go for anything.
So, all the information you have provided, Neeraj, so that was quite interesting. And, a good knowledge sharing podcast it is. So, thank you for, taking out some time for us. And, it was a great time with you.